Advanced Financial Accounting Excel Practice Problem. In this presentation, we will work a practice problem in Excel where a forward contract is used to hedge commitment agreement to purchase an item. Get ready to account with Advanced Financial Accounting. Here we are in Excel. We have the information on the left. We're going to enter that into the blue area on the right, including our journal entries and then our trial balance worksheet for year 1 and year 2 worksheets. Let's take a look at our information. As we do so, note this will look similar to prior problems, but it is different. So we're going to look through those differences as we go through them. So 121X1 U.S. company, that's us, entered into a 120-day forward contract to purchase Australian dollars. That component is similar to prior problems, and now we're going to look at the slightly different circumstances we have here. We've got the spot rate and the forward rate here, and we'll take a look at those shortly. The forward contract was to hedge a firm commitment agreement made on 12/1/X1 to purchase furniture on January 1st, X2. So now we have a commitment to purchase the furniture that happened on December, but we didn't actually make the purchase until, the commitment was to promise the purchase that's going to happen in January of the following year. So the derivative is designed as a fair value hedge. So let's think about that one more time. We have a commitment with a company in Australia to purchase furniture. We made the commitment, basically a contract, a promise to pay that happened on 12/1/X1. But we're not actually going to purchase the furniture until January of next year, and we're not actually going to pay for it until March 31st of the next year as well. When we do pay for it, we'll be paying for it with 100,000 in Australian dollars. So at this point in time, then we have some timing differences or timing issues we got to deal with regards to the foreign currency information. One is that we kind of made a promise to pay as of 12/1, but we haven't done anything. It's kind of like a firm commitment to pay, but we haven't actually made the purchase until January. So what we're going to do between that time frame from December 1st to January 30th, we could have a difference in the currency related to that time frame. Then once we actually make the purchase on January 1st, 2000X2, the next year, then we're still not going to make the payment on that purchase. So we have an accounts payable, and we have a time frame from January to March where the currency could change as well, where we have the accounts payable on the books. But the accounts payable is not going to go on the books until we actually make the purchase, which happens on January 30th, where we make the purchase on account. So the hedge that we're going to be setting up then is going to start at 12/1 when we made the commitment, even though we haven't not yet purchased the equipment at that time. And we're going to make it for 120 days, which is going to be like December through the time that we actually make the payment, which is on 3/31. So that's going to be a 4-month time period, or 120 days. Okay, so we're going to start this thing out on 12/1/X1. 12/1/X1. We're not going to put the equipment on the books at that point in time because we're not going to actually purchase it. We just made kind of a contract or a commitment agreement. We have a commitment agreement. So we haven't made the purchase at this point in time, but we're going to put the hedge on the books. We're going to put the forward contract on the books. And so remember, the forward contract is basically like a receivable and payable. So we're going to say we got a receivable and then a payable, and that's going to be the dollar payable. So the foreign currency receivable from the exchange broker, and then the dollar payable to the exchange broker, the foreign currency receivable in Australian dollars, the dollar payable to the exchange broker in dollars, right? And then we're going to say, all right, so this is going to be equal to the 100,000, and we're using the forward rate now as of this point in time. Remember, the spot rate is the exchange rate as of today. The forward rate is the exchange rate as of today. We're thinking what it will be we're predicting into the future as of the 120 days later, or on March 31st in this case. So we'll take this times the forward rate, which is 0.609, 60,900. So there's the debit and the credit. Let's go ahead and post this out. We got the foreign currency receivable up top. That will be the debit. We've got the dollar payable exchange and so on down here. that will then be the credit. Okay, so there's our debit and then the credit. So the next thing that happens is we're going to say it's the end of the year now, and we have to make an adjustment for this. So we're basically going to be recording an adjustment to the receivable portion first, and then we'll have to do another adjustment. So let's do that first. We've seen that in the past. So we've got this receivable on the books at the $60,900. If I take this at 1231x1, we can take then this 100,000 and multiply it times the rate. At this rate, the forward rate as of the end of the year that's spotting the end point, which is going to be the 331x2. So multiplying times the 0.612, that's going to be the 61,200. If we take that and we subtract it by the 6,900, then we have $300. So the $300 is going to be a gain because we're going to have to increase this receivable to the 61. If you think about that, we're going to say, well, we had $1 Australian compared to what we believe the forward rate will be 0.609. And now we had $1 Australian now compared to 0.612. So we could see that the Australian dollar then has gotten stronger because $1 Australian equals more of a US dollar. So it's gotten stronger, and the receivable means that we're going to be paid in Australian dollars, which are now worth more, have more purchasing power, or are relatively stronger compared to the US dollar. And therefore we got an increase and a gain. So we're going to say, all right, that's good. We got a gain here. We're going to go to the foreign. And then we're going to record a gain. So the other side being a gain. And that's, I'm going to calculate this time equals, I'm going to be picking up the larger of the two numbers we're dealing with, minus the smaller, because it's going to be a debit, which I want to be a positive. Multiplying that times the 100,000. There is the debit and there is the credit. Let's go ahead and record this out then. We're going to go to the foreign currency up top. Something's in it. I'm going to F2 plus F2. We'll pick up that $300, bringing it up to that 61,200, which we had calculated. And then we're going to go down to the gain, and we're going to say that's going to be the credit. Now, here's the new thing, the funny thing. You know, this is a little new because last time we had the actual purchase took place at that point. Because this contract was a forward contract, was a hedge for the firm commitment agreement, what we want to do is we don't really want this gain down here. I'm going to reverse the gain. What we want to do is put that difference is going to be included in the depreciable asset at the end of the day. So what we're going to do is we're basically going to reverse the gain, and we're in the end of the day, we're going to be capitalizing any gain or loss within the depreciable asset. So to do that, what we're going to do is I got to move this from a temporary account, from an income statement account, basically to a balance sheet account, right? So I'm going to say, all right, so we're going to record then a loss. We'll record a loss, which, you know, we'll cancel it out. And then we're going to record the firm commitment, and that's going to be for the same amount, for that 300 and the 300. So if we record that, then on the income statement side, we got the debit of the 300. So that's, you know, the gain and loss canceling each other out for the net income purposes. And then we have the firm commitment is going to be up top at the 300. We're going to record that here on the credit side of things. Okay, so then the next thing that happens, if we go to the next year, then we're going to be in the next year, and now we have the purchase taking place. So the purchase takes place in January 30th, but it's a purchase on account. So we're not actually going to pay for it on January 30th. We're going to pay for it in March 31st, but we're going to record the actual depreciable asset at this point in time. So I'm going to say as of 1/30 X2, we've got that information, but I'm first going to revalue the receivable as of that point in time, and we'll do the same kind of little transaction that we did up top, and we'll take that into consideration then when we calculate and put on the books the actual depreciable asset that we are purchasing. So this will make more sense in a second here. So we're going to do the same process. I'm going to say, all right, this is on the books. I can go down here at the 61.2. So the 61.2, and then at this point in time, we're saying that we have that 100,000 times, we're looking at the forward rate as of January 30th, which is going to be times 0.605. So that's 60,005. If I subtract that minus the 61.2, we get 700. So that's going to be a loss. And why is that going to be a loss? Because before we had $1 Australian compared to the 0.612. Now we've got $1 compared to the 0.605. So you get less US dollars, compared to the Australian dollar. So the Australian dollar got weaker. And since we're going to get paid, we're talking about a receivable in Australian dollars, then we're getting paid with something that of lesser value, resulting in the loss. So we're going to say, all right, down here we got a loss then of, and also just note that we're down here on year 2 worksheet. So these are the ending balances before, which I just brought down into the beginning balances now. And then the retained earnings represents the whole thing. And so we have our temporary accounts closed out to retained earnings. All right. So now we're going to record the loss. That's going to be a debit to the foreign currency loss. And then we have the receivable being the other side. Let's calculate it once again by saying equals. And then we're going to subtract these forward items out. I'm going to take the larger number minus the smaller number. So I have a positive on the debit side of things, and then we're going to say that that's going to be times the 100,000. There's our $700 debit and credit. Recording that out, we're going to go to the foreign currency loss down here. That's going to be the $700 debit, and then we've got the foreign currency receivable up top. We're going to say that's going to be the $700, and that brings us down to that $60,500 on the receivable. Now we're going to do the same thing with this firm commitment, because once again I got this amount down here, now a loss on the income statement. I really want that ultimately to go into the purchasing, to be part of the purchasing price of the asset. So what we need to do then is say, okay, now I'm just going to reverse the loss, which means we're going to put it into the firm commitment, and the loss is going to go down with a credit. So it's going to look like that, just to remove the loss. So now we're going to say firm commitment is going to be debited for the difference of the 700. And then we're going to have a gain, which is going to be the 700. And I put a loss. Hold on a second. This should be the gain. Just to cancel that out on the income statement. So the income statement is back down to 0. We now have $400 in the firm commitment now. So now when we record the depreciable asset, we're going to take that firm commitment into consideration. So now we're going to say on 130x2, we're going to put the actual asset on the books at this point in time. And then we're going to take the firm commitment off the books at this point in time. And the difference is going to be the accounts payable. So the accounts payable. So we could think about it this way. We could say, all right, the accounts payable, what we're going to owe in the future will be. Now we're going to use the spot rate, remember, to put the payable on the books. So as of January 1st, we got the 100,000 times the spot rate this time at this point in time of the 0.608. So I'm going to say this is going to be, I'm going to say negative to make it a negative number or a credit. The 100,000 times, we're using the spot rate rather than the forward rate to put the payable on the books at 60,800. Then we've got this 400. That's what's going to be, we're gonna remove basically the 400. It's got a debit here. We're going to then credit it to remove the 400. I'm going to do it this way so you could see it. If you work on the Excel sheet, you could just put a credit of 400, but I'm going to say the 300 plus this change that we had here, which was the debit. And so there's the 400, and I'm going to make it a credit. And the reason I'm doing this is I want to, if you're using the worksheet, I want you to be able to see where the calculation comes from. And I can't use, of course, that 400 because it'll create a circle reference. And then I'm going to say this is the negative sum of these items. And there's the 61,200. So now we're putting the depreciable asset on the books for the 61,200. So depreciable asset then going on the books. We're going to put that on the books at the 61.2. Note that we haven't recorded any basically gain or loss with regards to the currency transactions between that date. We're basically capitalizing them or putting them as part of the depreciable asset. And then we're going to go to the firm commitment, and I'm going to say F2 plus F2. That's going to be the 400, bringing that down to 0. And then we have the accounts payable on the books now. So now the accounts payable is on the books, and there we have it. Now we still have the forward contract on the books now, but it's kind of serving a different purpose. That first timing difference has taken place now, and now we've got the payable on the books, and we have the similar kind of situation we saw in the past where the payable's on the books, and we're going to, and then there's a difference between, you know, the timing difference could happen between the point in time that we have the payable on the books and when it is actually paid, which will happen on 3/31. So on 3/31, the actual payment is going to be made, and we've got two things we need to adjust for. One will be the accounts payable, and the other is going to be for the forward contract. Let's think about the accounts payable first. So if we say, all right, now the accounts payable, we just put it on the books at that 60,800. So we're going to compare to that 60,800, and we're going to take this 100,000 times the current spot rate, which is the 0.602 times the 0.602. That's going to give us the 60,200. 60,200 minus what's in there, 60,800, is a difference of $600. $600 is going to be a gain. Why? Because before we had $1 Australian is going to be 0.608 US dollars, and now we got $1 Australian is 0.602 US dollars, so less fraction of a US dollar compared to the Australian dollar. That means the Australian dollar got weaker, and in this case we're calculating that we're going to be paying in Australian dollars, and the Australian dollars are now worth less, and therefore that's good to us, so that we're going to have a gain there. So we're going to say, all right, then the payable, we'll record the payable, and the other side is going to be going to a gain. So now we've got a gain, and that is going to be calculated. Let's do the calculation again. It's going to be brackets. We're going to pick up the 608 minus the 602. I'm taking just the larger number minus the smaller number to come up with a positive number on the debit side of things, times the 100,000. There's our 600. Let's go ahead and record that out. We have the accounts payable. So here's the accounts payable. Double clicking on it, go into the end of it, plus we'll pick up that $600. Then we have the gain. So going down to the gain, going into that, plus we're going to pick up the $600 credit. So next we'll think about the forward contract, and that's got the receivable here. So now we've got the receivable at the 50,000, at the 60,500. We're going to do the same calculation, which is the 100,000 times the 0.602, and you might be saying, hey, why are we using the spot rate now? Because the forward rate represents us predicting into the future, the rate that we think in the future, kind of. And right now we don't need to predict in the future because it is this point in time. The point in time is this point in time. So the spot rate is the only rate. So we have the 60,200 minus the 60,500 that's currently in there. That's a $300 difference. That $300 difference is going to be now a loss. Why? Because before, $1 Australian was 0.605 US dollars, and now $1 Australian is 0.602 US dollars. Therefore, the Australian dollar got weaker Australian dollar, but now we're talking about us being paid in Australian dollars, and so we're getting paid in something that is now worth less. So we're going to say, all right, there's a loss. So that's going to be on 3/31, and we're going to record the loss then is going to be the debit, and then the other side is going to be going to the foreign currency receivable. Let's calculate it again for the fun of it. I'm going to say equals brackets. I'm going to take the larger of the two numbers that we're going to be dealing with minus the smaller of the two to make it a positive. Close the brackets, multiply that times the 100,000. So there's the debit, and there is the credit. All right, so then we'll go ahead and record that out. So we got our loss. So that's going to be here. Double clicking the loss, going to the end of it, plus the $300. Then we've got the receivable. So we'll go up top to the receivable. Something's in it. Let's double click on it. Go to the end of it, plus pick up the receivable. Bring in the receivable down to that 60,200, which we had calculated previously. All right, next thing we're going to do, we can pay off the dollars payable to the exchange broker, because this we just pay off in dollars. So no big deal here. We promise to pay them later in dollars, and that's like our currency. So we just pay them off. So we're going to say, all right, that's going to be paid off in dollars. So the accounts payable is going to be, or the dollar payable is going to go down. That liability is going to go down, and we're going to pay it with good old dollars. Nothing crazy going on here. Now, note that we're going to say that this 60,900 is the same 60,900 from the beginning. So that it's just this first transaction. We haven't done anything to it. We haven't been changing it for currency things or anything like that. That's in dollars. And then we're going to say this is the credit. So then we're going to say this is the liability is going to go back down to 0. And then we've got the cash that is going to be decreasing as well. So we'll decrease that. So there we have that. Next, we're gonna get our foreign currency, and we're gonna remove the foreign currency receivable from the exchange broker. So we have this receivable from the exchange broker, 60,200. We're gonna get that in Australian dollars, but we're gonna represent that on our books with the current equivalent, which is 60,200, which we had just calculated using our, our tables over here in the spot rate for the current time. So we're gonna say this is 331. This is going to be equal to, we're going to be picking up then the foreign currency units. So we're getting currency, but we're holding on now to those foreign currency, but we're showing them in basically US equivalent dollars. And that's going to be for that 60,200, which we could recalculate. And why wouldn't we? It's good times to do so. By taking this 100,000 times the current spot rate, the 0.602. And then there's the debit, there's the credit. If we record that out, we're going to say, all right, there's the foreign currency in Australian dollars. And then here's the foreign currency receivable. Double clicking on that, going to the end of it plus, and picking up the credit, which should bring that back down to 0, which it does indeed do. So then we're going to say that the last transaction, we're going to be paying off the payable now. So now that we have our foreign currency, it's represented here in dollars, but it is that $100,000 of Australian dollars we can now use to pay off the payable, which is also represented on our books in terms of the dollar value equivalent, but which we will actually be paying with that 100,000 Australian dollars that we are holding on to. Okay, so then we're going to say that we have then the payable is going to be going down with a debit, and we're going to be crediting then the foreign currency units that we have there, and that's going to be for the 60,200, which we can calculate one more time because we're getting good at doing that. It's going to be the 100,000 times the current spot rate, which we adjusted that payable to be 60,200. So there we have the payable. So here's the payable, double clicking on it, going to the end of it and saying plus, we pick up that 60,200. It goes down to 0. Then the other side is going to go into the foreign currency in units, double clicking on it, going to the end of it plus. We're going to pick up the foreign currency units, which will make it go back down to 0. We have now paid that off. So end of the day, cash, here's cash. We still got that. We got the depreciable asset on the books at the 61, which is a slightly more complicated situation due to the way the forward contract worked, right? We had to deal with the forward contract where we capitalized the gains and losses, and then we included the gains and losses not on the income statement, but we kind of included them as part of the depreciable asset, and then we kept the forward contract going until the actual payable was paid. So then the payable finally went down to 0. We've got the dollar payable to the exchange broker has now been paid off. The firm commitment is now gone to 0. It's been included in the depreciable asset. And then we have the current year for year 2 gains and losses recorded, prior year gains and losses recorded up here. Those two both canceling out to 0 because those have been included as part of the depreciable asset. These two being reflected because we're recording the gain and loss for the point in time period after we had the payable on the books to the point in time the payable was paid.